Hello, Metals and Markets listeners out there. Before we get to this week's interview, I wanted to give you all a quick heads up on the latest news, as gold and silver prices closed this week flat, slightly down from the end of last. Gold spot is likely to close below the psychological $1,200 an ounce mark, while silver looks to finish this week at the low $14 an ounce level. In industry news, in the middle of this holiday shortened week, the U.S. Mint announced it was temporarily sold out of 2018 Silver Eagle coins. Then today, a similar communication was made by the U.S. Mint regarding 2018 Gold Buffalo coins being temporarily sold out too. What most likely occurred here was the U.S. Mint was probably caught flat-footed with increased bullion buying demand from last month to today as precious metal spot prices have fallen. More than likely, they do not have enough planchettes, and thus they probably don't have enough inventory on hand to meet the resurgent demand. You can find 2 recent articles I've written on Silver Doctors with more details about this story. The good news for active bullion buyers out there is that there does remain many high-quality bullion products available at all-time low-price premium points. One obvious example is the following deal on Austrian Silver Philharmonics running through the end of this month at SD Bullion, where you can buy 19 Silver Philharmonics and get the 20th coin for free.
Welcome to this week's Metals and Markets podcast. I'm your host, James Anderson of SD Bullion. This interview is being recorded at 10 a.m. Eastern on Friday, September 7th, 2018. With us this week is Ned Naylor-Leyland, a gold-silver fund manager at Old Mutual Global Investors. Ned, thanks for coming on the show.
It's my pleasure.
Well, Ned, we've gone back and forth, I think, for years now, online and stuff, but it's really nice to finally speak to you voice to voice, at least on a first-hand basis. I wanted to start by just getting a little bit of a background of who you are and why you're involved with precious metals. It seems you've been working in the London financial markets for almost 2 decades now. And I'd like to begin by tracing the line that brought you into the precious metals. What drove you into specializing in them and precisely why?
Sure, of course. So I'm sure some people probably who are listening to this may know this story before, but I will certainly go through it. Basically, I came in sideways. I was studying at the time, and I came across the repeal of Glass-Steagall and found this completely bizarre situation that the commercial banks would be allowed to speculate with customer deposits effectively again. And that just made me very interested in finance. And I tried to find a way into the city because I, to my surprise, found the subject interesting. I probably hadn't thought it was before that. I managed to get a job in the private client business, worked in private clients for a long time, but immediately interested in the monetary system. And I was lucky. I read Ferdinand Lipp's book Gold Wars very early on, and that lays out obviously the history of the cyclical nature of credit money and sound money. That was very much the foundation. And very quickly, because we went into a negative real interest rate environment during the 2000s, obviously the bull market sort of started, nominal bull market in dollar terms. And I increasingly became interested and wanted to focus on that subject. I then opened a small, really private fund for clients in my old job, and then 3 years ago got a big serious job in the sector with the Old Mutual Global Investors, and we launched the Old Mutual Global Investors Gold and Silver Fund 2.5 years ago. We buy both bullion funds and gold and silver equities. We're a little bit different than others because we think that you should have both physical and the miners, and that you should use the beta of silver to drive the alpha of the fund. That sounds very technical, but it's not really. It's a fairly untechnical statement. And that's, I suppose, the timeline of where I've got to where I am.
Mm-hmm. And so when you were in university, were you taught anything about gold, or was it more of a self-study?
No, it's very much a self-study. Originally, I was a languages student, which is why I said that I was surprised I was interested in finance. It wasn't really on my radar, but this seems so strange, the way that things were happening with that Glass-Steagall repeal, that it drove me to want to look into the subject more and led me into it.
Now, of course, precious metal prices have been trending lower of late, and a lot of people have been, citing U.S. dollar strength as a result of emerging market U.S. dollar denominated debt increases over the last decade as being a big reason as to why precious metal prices in dollar terms are down. And I mean, basically in a lot of currency terms, in various fiat currencies, it's down of late. So I'm wondering what you're seeing in precious metal pricing structure of late, outside of that or with that. What are your thoughts?
So, look, I think I see things maybe a little differently than some people who speak about the subject. The first thing is you may or probably have seen me fairly noisily stating that the dollar and gold are not actually inversely correlated. And I would certainly wish to linger on that slightly. This is a narrative which is very common and indeed actually is traded by people. But I'm going to tell you, it's just completely not true. The dollar and gold is a cross rate. The $1,200 an ounce is the cross rate. So, if you imagine cable at 129, you can't say that sterling and dollars are inversely correlated to each other. It's just a number, the same way that the dollar gold price is. Now, that's not the whole story, because it is true that US dollar gold and US dollar real interest rates are very, very well, clearly inversely correlated on a forward-looking basis. And the reason why is because gold hedges cash. It hedges loss of purchasing power in cash. So the cash and bond market are always making a judgment between owning cash and owning gold on a forward-looking basis. So the relationship really is not the way it looks. However, it is true, as I just said, that people still place that trade, and they do it in a speculative way using margin in the futures market. So lately, you'll see that people place this trade, even though, as I'm telling you, it's actually imaginary. So they'll go long DXY, which is obviously just a basket of dollar cross rates itself, and then they'll go short dollar gold. But that actually isn't really a trade. I mean, it is, because it becomes self-fulfilling and people put it on, but I don't really see it that way. I think all that's really happening here is, for about 2 years, the Fed primarily, and other central banks I think really just feed off the Fed, have been very successful in maintaining people's comfort zone in the cash and bond markets. And the way that I explain that usually is to say, in the bond market, people are still willing to pay 101 cents for a dollar of purchasing power 7 to 10 years in the future. That's to say, the bond market is believing that the dollar will have the same purchasing power 7 to 10 years ahead as it has today, or slightly more. But if you actually ask people on an individual basis, including people in the bond market, they would laugh at that and go, no way. And actually, people I speak to say it's more like 50 cents rather than 101. So when you see the price action in gold, really all it is a function of people's confidence in that number. And I think that number can go very quickly, as in go south very quickly, but it will be a function of either rate hikes being removed from the curve all in one go due to equity markets going lower or some geopolitical risk item. But the thing to understand is in gold, you're always paying every second of every day for the bond market's forward-looking expectation on rates and inflation. That's really what it's about. It has taken me a long time to really clock that, and I'm pretty comfortable that it works. But that isn't to say that other people don't trade it on other basis, which of course they do, and to a degree that has a self-fulfilling nature to it.
Obviously, you mentioned real interest rates in gold, and when real interest rates are negative, as they are now, regardless of the lies they have with inflation, they'll tell you inflation's 2% when you know it's probably about 10% if you live in a city on an annual basis. So real interest rates, I'm not sure if we'll, in our lifetime, maybe as we get old and gray, they'll come back and be in a positive area. But in the next few decades, I don't understand how anyone thinks real interest rates are going to get positive again, at least with these debt levels the way they are. I mean, do you agree with that statement?
Yes, I mean, I agree with the statement, but I think it's just what's important here is cognitive dissonance. It's the idea that a bond market participant can tell you it's 50 on 7 years ahead, which is actually, by the way, the same number you just came up with. That's 10% per year inflation, pretty much.
Right.
Takes you to that number. Yet they'll pay 101 on the screen. So, look, I think we're already in a parabolic collapse of purchasing power in all these paper currencies, and everybody knows this anyway, really. So I don't know whether in our lifetime is really right. I think that we're pretty close to some kind of monetary reset.
Right.
I mean, I would have told you that 5 years ago, though. So I have to make that point.
Sure.
It's about when do people actually recognise with their assets, with what is on the screen, what they already know. I think explaining it in this relatively simple way and saying, look, if you use the real data of 10, 11, and you can obviously show this using things like shadow stats and stuff, you can show really that is the number, and just push people to consider this, that they are facing that reality. Then people will start to behave in a different way, and I think it will happen all quite quickly. But for me, as I just said, I think the thing that really matters is the hikes. Right now the bond market's pricing in 4 more. Now, anything other than sort of unicorns trotting down the high street is going to make those hikes disappear. That's to say, I don't see really it viable that we're suddenly going to get 6 rather than 4. But I think it's very likely that we'll end up with 3, 2, 1 or 0 due to something happening. That will drive real interest rates heavily down very quickly. And then I think it can spiral from there pretty rapidly, particularly, obviously, if you get an inflation spike at the same time. So if it happens to be something that involves oil going up, what would happen is you get inflation expectations going up, rate expectations going down, and that's a double whammy. And that would really light a fire under the situation. I think then the reality of the fact you're already losing 10, and I completely agree with you on that number, will become more obvious, and people will behave according to what they already know, which is what's not happening at the moment.
Right. So you're basically talking about a game theory situation where you have enough of the crowd finally realizes, oh, hell, I need to have precious metals, and they go out and get it. I mean, at a certain point.
Yes, I'm saying that, but I'm also saying that it's also, as much as that, it's actually a function of people not wanting to own cash, bonds, and money markets. It's probably more important that they stop wanting to own those.
Right.
Because I think the owning gold and silver thing sort of comes after it. I mean, for you and me it doesn't, but for most of the market, what it becomes about is that I just can't do this anymore. And I think actually really you're seeing that anyway in equities, which is at the margin, the clever money for some time has been a trickle away from that part of the market and towards equities on a basic, I can't hold this anymore, rationale. And I think that, yes, gold and silver historically is always the primary beneficiary of that kind of change, but it's more for me about people just saying, I can't carry on holding that stuff, it's on fire in my pocket. And so I think it will happen that way.
So obviously with your fund, you're serving large institutional investors. I'm wondering if you might take us through a few of the standard objections you may run into professionally with your fund. Like, I mean, obviously you're meeting and speaking with various people, and so I'm wondering, what are some of the things that come up with large institutional investors? What are the issues they may have with looking at precious metals, especially right now at these price points?
Yeah, I mean, it's a number of things, mostly to do with education and lack of understanding of the asset class, actually. So when I talk to them, a lot of what I do is an education piece first before I talk about what we do in the fund. I mean, a lot of the time it's really quite sort of banal lack of understanding of what the point of the asset class is. So that's always one thing. There's also some more important sort of structural things at the moment, which are everybody's a momentum investor at the moment. I mean, everybody. So even if you explain it well and people understand why, and they sort of stroke their chin and think, wow, we should be doing this. There's also this, but it's not going up already. I know I'm laughing because it just seems so ridiculous that I'm saying that, but it's very, very true.
Oh, yes.
Most institutional money now is under more and more pressure from the clients that everything on the screen should be going up at the same time, which is terrible portfolio management practice, as you all know. That's not what you want at all, but it is what the clients want and expect nowadays. So that's a big difficulty, and I would add to that the issues of benchmarking. It may not be such an important problem over with you. I don't quite know how it works in the US, but most institutional money here is very much benchmarked to behave a certain way, and that does not involve gold stocks. So taking that position on means you're taking benchmark risk, which means you have to have a lot of conviction and a lot of certainty that you're doing the right thing to take that view. Now, there are people who will, but there are lots of people that will be nervous doing that.
Now, obviously, you're in London, so my hunch is you probably do occasionally meet and engage with people who are active bullion traders. Is that the case? And do you ever end up speaking with people who, for instance, work at JP Morgan in London? I mean, I just kind of came up in my mind right now. I wonder what that's like and what type of conversations you end up having.
Sure, great question. Yeah, it doesn't happen that often, but it has happened. Probably 3 or 4 times I've met bullion banking guys. And usually the conversation is quite fun because I think they enjoy the fact that I have a reasonably good understanding of how it really works. So my use of language is sufficiently accurate that they are happy to have a conversation about it. But generally it all comes to the same thing, which is I go, so it does work like that. And usually then the language turns to nods and facial expressions rather than outright words. And I go, well, it's because you're making money in the meantime, and pretty much the nodding carries on.
Right.
So look, I think it's key to understand people who do that job understand very well what they're doing, but it's a form of banking. Bankers are bankers. They behave a different way than, let's say, a gold bug does.
Right.
They see things a different way, and I suppose my own perspective on all of this has matured a bit since when I first sort of started to read and understand all of this. I would have been a bit more angry about it. Now I find it amusing, really. And like all banking rigs, it will fail at some point. But one has to be position sized and use the right instruments in the meantime, so you're not timed out on this trade. I think that's the key thing.
Right. If you're late to the trade, you may not even be able to get in it at the right time. Got it.
Yeah, but equally, if you're in too early and you use the wrong position sizing and the wrong instrument, you'll also get timed out. So it's both ways.
Sure. Now, I've been reading some of your blogs that you've wrote over the last year, and I ran into one I found kind of interesting. It's probably interesting, especially for people up in Canada who may know of the various funds. You had written about the early 2018 takeover. I think you wrote in 2017 that you were against Sprott taking over the Central Fund of Canada, which is a trust that holds gold and silver in Canada. And I was wondering, first maybe why you could cover why you were perhaps against that takeover, and and why, if you are disappointed, and why exactly so, just based on your experience.
Yeah, so look, there were multiple reasons why I was against that. And so far, it looks like it was a reasoned argument based on what's happened since it went through. Look, first thing to say is there's a selfish motive too, which is I run a fund which was investing in both spot products and central fund. Mm-hmm. So for me, on one level, also, I didn't really want to own 3 spot bullion products. So that's number one. It's the least important reason, but I must make that point up front. Concentration of management of assets, which isn't ideal. The second thing is that I for the longest time I owned central fund at a big discount to NAV. I've eaten that and been okay with it because the structure of the product was the way it was. But part of the reason for being happy doing it was the fact that in due course, when markets heat up, historically you get very big premiums in the central fund.
Sure.
One of the reasons why is because the problem of gold obligation products is obviously so big that when people become nervous, they pay up to own central over and above the paper products, if we want to call them that. So I was always very happy with central on that basis, and if, let's say, it went to a 15-20% premium, which it certainly had done before, I could take that premium and maybe take some of the profit, reinvest it in the spot products, which obviously wouldn't trade at big premiums due to their convertibility function
Right.
or redemption function. So, I wasn't happy with that at all. It's also an expensive change in management, so fees are going up. And then just to make it even more sort of annoying, it's still trading at a 4% discount. So we were all told, oh yeah, that will go, and it hasn't gone.
I got it.
And what's more, being completely frank with you, a fair bit of bullion has actually disappeared since they did that, which is a little bit alarming. Now, it has slowed down recently, so I think it's probably okay. And I've spoken to Sprott a fair bit about this to make sure that they do have the ability to manage the situation should it start to become accelerated, and I think I'm comfortable with it. But for me, Central was a more simple vehicle despite the premium discount point, and I liked it very much. And yes, I wasn't happy with it, but I did seem to be a bit of a lone voice in that. And unfortunately, despite doing a lot of lobbying, I didn't get much support, and somehow it went through.
Yeah, no, that idea of arbitrage for a fund manager makes a lot of sense, and I completely understand why you probably felt like it was good having different and not under the same management. So it makes a lot of sense. For listeners out there, obviously that's deep in the weeds, but I figured they may find it interesting because those are two big names in the gold and silver trust that are traded actively on financial markets. So just to close it out, I wanted to get a feel from you. We have guys like Jeff Christian of CPM Group, and he's calling for new nominal price highs of gold and silver by 2022, 2024 as a result of another financial crisis and reinvigorated investor demand. I wanted to hear from you about your, the precious metals and your longer term thesis on how this all may potentially play out. I mean, going into the next decade, how might their valuations start going up, and how may this end up going? There's a lot of people who think there may be some type of new monetary system where there's a revaluation that happens very quickly, and obviously there's other arguments. So obviously I'm not pinning you to a prediction here. I'm just giving you the open floor just to give me what your feeling right now is and how you see it maybe coming to fruition.
Yeah, I wouldn't. I'm not really of the view that it would be re-rated overnight. I mean, it's not to say that can't happen, but I think that would look too odd. If you follow my thread here. I think it's more likely that what I was talking about earlier is the way this will play out, which is through the bond market. So basically, 101 starts heading towards 50. I just re-explain that point because in my head it's very clear what I'm saying, but it may not be to the people who are listening. So what I'm saying is that the markets are currently saying that the purchasing power of dollars will remain steady, which really is absolutely absurd because it's certainly not true of the last 7 to 10 years that a dollar buys you the same goods and services as it did 7 to 10 years ago. So how it couldn't be exactly the same as the last 7 to 10 years or worse, frankly, it will certainly be worse, not better. It's just madness. So I think what it is simply a case of at what point does that trickle of money from cash bonds and money markets into physical assets, of which at the moment equities are the primary beneficiary, becomes more like a river, and then probably even larger than a river. So I see that the price change will come through that. I think it will be not overnight and also not a year. I think it will be pretty quick, but I don't think it will be overnight. So I think people will start to realize things basically on the basis of, oh wow, we're not only not getting more rate hikes, we're probably getting cuts. That will take what are already very tenuously flat real interest rates, and you said they're not flat, they're very negative already, but in the bond market it will take them from broadly flat to minus 2, 3, 4, at which point I think you will see capital will move. That will make the price move, and then I think we're in some sort of spiral environment, and on the back of lots of things happening, then I think a new monetary system would probably appear. But I wouldn't see it being a click the fingers, here's the solution before the problem comes kind of thing. I don't see that really being very likely.
Right. So you're talking about a problem that lasts for a while and then the solution eventually appears.
For me, that seems more reasonable. And just to touch on that Bitcoin point, I still feel that if I'm really pressed on it, I feel that Bitcoin really is probably training wheels in some way for this new monetary system. That's what it feels like to me. I still would say that owning none is not the correct allocation. I probably have a lower allocation comfort than many. It's sort of 1 or lower percent. But I do think to be completely out of that, because I do feel that there's clearly something here which makes sense in terms of how you would frame a new monetary system in the modern world. And I feel that there's some confluence there between what we're seeing with Bitcoin and distributed ledger technology and some kind of new cashless society monetary system which might be delivered on the back of what's coming, I think.
Right. I mean, if you take the time and read the Bank for International Settlements, some of the things that are published there, I mean, it's pretty obvious that is, I think, the ultimate end game that they're hoping for is to have central bank issued currency as opposed to fractional reserve issued currency. So it's, that's obviously a big topic, and we're closing the interview soon, so I don't want to go too deep into that. But when you're talking about Bitcoin or precious metals, those are some of the loan asset classes that are really outside of that. It's a brave new world, and we're moving into it faster than I think most people realize.
Sure, absolutely, and as I said earlier, the point is to be hedged to the right quantum for your own personal risk profile, in the right instruments, and in my personal opinion, even more importantly, don't be timed out of it. So don't put yourself in a position where you can get timed out of your insurance policy. And also, I think those of us that are interested in these subjects, we are demonstrably early, probably even now. It feels impossible to say that with what I'm seeing, particularly as the rhetoric that you're seeing now is so aligned with everything that you and I would have been looking, reading, and talking about for a long time, that it feels like things are really close. But on the basis of the last 15 years, I would say we may still be a little earlier than we think we are.
Yeah, I mean, I agree. I think we're talking about sometime early in the next decade that this starts to happen. So we may be a few years, or maybe this fall. Who knows? I mean, that's the thing about precious metals, and what you mentioned about taking a prudent position and not being in a place where you get timed out, or meaning that you have to make a change because you got too aggressive. So I completely agree with what you're saying. So I want to thank you for coming on the interview this week, Ned. I appreciate you taking the time out for our listeners. Is there anything else that you want to get across to them before we close it up?
Not at all. I'm just grateful for the opportunity, and you guys have been there, all the way through, and hopefully at some point we'll meet face to face when I come to the US.
All right, great. Ned, what's your Twitter handle, by the way, in case people want to follow you there?
It's at NedNL.
Perfect. Well, Ned, thanks so much for coming on this week's Metals and Markets podcast, and we'll speak again soon.